Well, every dollar that we earn is taxed. It's going to be that way. And so there's no way to get forgiveness on this. It's not something that the government's going to come down and say, hey, we don't need the money, so you keep it. We're not going to tax you. I think, the problem we've got is because we have developed, some people have done a really good job of deferring money, being frugal, planning for retirement. And then we have another part of society that has lived for the moment. And so as we get older and as we retire, then I can see that some of those people that have saved a lot of money in their retirement accounts may be penalized more than those that haven't, in order so that the government continue to fund their debt.
Welcome to Financial Focus, brought to you by GulfCoast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have been providing North Florida savers and investors sound, comprehensive financial guidance for over 30 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting GulfCoastFinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the best of the best in financial services, as named by the readers of the Lake City Reporter, 8 years and running the team from GulfCoast Financial Services, and founder CEO John Kuykendall here with us, providing the financial, investment, and retirement planning guidance that we need. More than 30 years serving North Central Florida savers and investors. And John, along with our money, our investments, our financial decisions, come tax implications. And we all need to do maybe a little bit better job of proactively planning for trying to control that tax liability.
Peter, that's one thing that I think a lot of people are complacent about. We know we have to pay taxes, and we know that there's no way around it. I mean, at some point, even if you file an extension, you're going to have to do those taxes. And so we put it off. We really don't plan. And I know when I was younger working for a salary, that was one thing that we never, they took the money out of your paycheck. And at the end of the year, if you got a little bit back and didn't have to pay too much, you were happy. But we never did any planning for taxes. It's something we're not taught. It's something that we don't normally do. But as we get retired and we start pulling money out of our accounts, we find out that it's much more important to be proactive with taxes than ever before. And, it's kind of like we've been taught over the years for too long a time that we should defer, that it's better to pay the taxes later than to pay them now. But, as I've gotten older and I'm paying taxes on my money I'm having to pull out, I'm wondering if I did the wrong thing, because I could have paid taxes on the seed and then the harvest would have been free. But instead, I paid taxes. I'm paying taxes on the harvest, which was much more than what we put in because of the power of compounding all those years and just the way the accounts grow. Now I'm having to pay at a much higher rate, and I'm in business with the government because they're my partners now. But I don't have a say-so in how much I'm going to pay. And so, I think it's, what was it, Will Rogers that said the only thing certain is death and taxes?
And I think he also said, I'm not so concerned with the return on my money, just the return of my money. And taxes certainly kind of stand in the way of that. So obviously there's a fundamental difference in the way that we approach taxes during our working career versus how they are handled in retirement. John, is the American public actually being taught to set themselves up for a higher tax liability in retirement then?
Well, I think that's true. I think what we've done is that we have taught Americans after 1980, when we did away with the defined benefit plan and started the 401k, it was a way that we deferred these taxes. We still paid taxes on the money we made that we didn't defer, which was enough to keep the government going. But we were taught to defer, and then we would be in a lower tax bracket when we retired. I don't know how many clients I talked to when I first got started and spouted those words. Don't worry about the taxes now, because when you retire, you're going to be in a lower tax bracket. But what we found is that because of inflation and the cost of living continuing to increase, that we're actually having to pull more money. We're having to live on more money than we thought we would. So what we could live on in the year 2000 is a lot different than what we can live on in 2022. And it's going to be that way going forward. And so we need to think about retirement and saving in a different light, because we don't have any guarantee that the government's not going to raise rates. Peter, you know as well as I do, with all of the money that we have given away and all the money that we have borrowed and the amount of interest that we have to pay on that money, there's no way conceivably, unless we had a tremendous birth rate and had a huge new workforce, that we're going to be able to pay for, we're going to be able to have lower taxes. Lower taxes are a thing of the past. Taxes have to raise in order for us to pay the debt. So that's just natural.
John, we were told about the benefits of triple compounding in deferring our retirement tax dollars, the compound interest that happens on the principal, on the growth, and on the money that we would have otherwise already paid tax on. However, Albert Einstein said the most powerful force on the planet is the power of compounding interest, and the IRS understood that, I feel, when they let us defer and delay paying that tax bill. And what they didn't tell us about was the triple whammy that would hit us in retirement, in addition to the tax that we must pay on the principal, growth, and the deferred tax amount. It also impacts the taxes that may be due on Social Security and the potential cost of our Medicare premiums.
Well, that's right. Up to 85% of your Social Security is subject to taxes based upon how much you make. And so the more you make, the more you have to pay a tax on that. Also, our Medicare Part B is indexed for income. So the more I show an income, the higher my premiums are going to be. So all of those things, and also my drug card's the same way. My Part D is also cost more if I make too much. So all of those things compounded with just the fact that we have to pay the taxes at a higher tax rate than we thought, and the capital gains. Don't forget capital gains. The more we make, the higher the capital gains bracket is. So, all those things compounded take into consideration the fact that, we were misled. We did do the wrong thing. It would have been better to have put that money in a municipal bond or in a Roth IRA back then and have it compound over time and not have the ability to pay these interests now. It's going to be hard. It's hard on a lot of people to pay taxes.
Now, if you already have a large tax deferred balance, don't kick yourself, congratulate yourself, and give yourself a pat on the back. You've done a good job. But the next stage of the game may be about keeping as much of your money as possible and controlling that tax liability rather than shooting for as high a market return and growth as possible. Both are good, but keeping our money and minimizing taxes is going to be the next phase highest priority. So, John, there are several things that we can do to control and minimize that tax bill. One of them being paying that tax bill.
Well, that's right. If you're prior to 65, it may be advantageous for you to do a Roth conversion on a good portion of your deferred money so that later we don't have to take that out, and it can grow tax-free, compounded, and it will make it back up over time, hopefully. But, the thing is that we need to do things like municipal bonds, tax-free accounts, annuities, things where we can defer and not have to pay that tax now on that money that we're having to pay the tax on, but to make it the lowest. The government's talking about raising the required minimum distribution. And as you know, right now, the required minimum distribution is 72. And that's having a huge effect because we have to take that money out. The government says the required minimum distribution has to come out at 72. That may put you in a higher tax bracket. But now, Peter, think about it. We changed the laws in 2019, said that the IRAs that are inherited can go to the spouse and they can take it out over their actual lives. But if it goes to another beneficiary other than the spouse, we have to take that money out in 10 years. So if I defer this required minimum distribution to 75, am I not compounding my accounts more so that when I give them to the beneficiaries, when I pass away and my spouse is gone, that they're going to have a higher tax bill than they thought they would because now they're taking out the required minimum distribution, but it also adds to the amount of money they make based upon their salaries. So they could even be in a higher tax bracket and create some real tax challenges for them.
And we can either default to the IRS's plan or be proactive in controlling that tax liability with our own plan. John, rarely have we found that defaulting to the IRS's plan is the plan that is in our best interest.
Well, that's true, Peter. You got to remember during World War II, the highest tax bracket was 94%. Now, you know, all through history, I think the average tax bracket since they were implemented in 1916 is 57%. That's the average of all the tax brackets all the way across from 1916 to now. So it shows that the government can raise taxes. They are going to raise taxes. Taxes have to be raised in order to fund what the government, what the representatives want to fund, the pork as we call it, and sometimes, or their initiatives, and then also to pay for the operation of the government. Now, because of COVID and the amount of money that we've given away since 2020, this just almost doubled our tax liability that we owe and how much money we have to pay. We can't continue with this tax thing. They have to increase. Do you realize that when we first started, when we opened the amendment in 1916, the tax bill was 4 pages. Today, it's 106.
They still have those original 4 pages. They've just continued to add on to it, right?
Yeah. Well, I mean, if you look, during World War I, we raised the rates from 15% to 67%. During the Depression, they went from 25 to 64. World War II, they went up to 94, as I said. In the 1980s, they went from 70 back to 50. Then in the 90s, they went down to 39.6. Today, the highest tax bracket is a little over 40%. So taxes have to go up. And it's not just going to be on the rich people, Peter. What's going to happen is that top bracket's going to pay a higher rate, of course. But as we middle class, as we make more and as we have to take money out of these IRAs, we're going to be in a higher tax bracket than we have been in the past. We have to be.
And the majority of Americans' wealth is actually stored in tax-deferred retirement accounts. And so those could be a big target and subject to whatever tax changes do come about. When you defer the tax, you also defer the ability to set the terms, and the government gets that ability. That's where they have some amount of ownership over those retirement accounts. Now, John, we sort of have this belief that if we ignore taxes or defer taxes, that taxes will go away, either when we retire or maybe when we pass these assets on generationally. I know you spoke to this, but there's never a dollar that's created or earned or grown or withdrawn or that passes generationally that the government seems to just forget about and give us a pass on.
Well, every dollar that we earn is taxed. It's going to be that way. And so there's no way to get forgiveness on this. It's not something that the government's going to come down and say, hey, we don't need the money, so you keep it. We're not going to tax you. I think, the problem we've got is because we have developed, some people have done a really good job of deferring money, being frugal, planning for retirement. And then we have another part of society that has lived for the moment. And so as we get older and as we retire, then I can see that some of those people that have saved a lot of money in their retirement accounts may be penalized more than those that haven't, in order so that the government continue to fund their debt. So, I'm just more and more concerned about indexing and how we're going to index our taxes, our withdrawals, all of the things that we have to do. Social Security even is going to be based on income. So while you may think that you're entitled to 100% of your Social Security, you may not get 100% because you make too much, or you've earned too much, or you have too much set aside for retirement. So those are all concerns.
So, John, what are you talking about with your clients right now that do want to plan proactively to help control and minimize their ultimate lifetime tax bill and liability into the future?
Well, the one thing we're talking about, of course, is the Roth conversions. We need to get those done prior to 65 if we can. We even look at it doing it after it, even though it will affect your Medicare Part B. But Medicare has actually waived that increase in certain cases because it was a one-time Roth conversion. So we want to get that money taken out of that deferred account and go ahead and pay the taxes now, where we know what the taxes are, and then let it grow so that we can pull it out tax-free. Secondly, we're looking at taking, a lot of people have non-qualified money that we pay tax on every year. And so we're looking at taking that money and either putting it in municipal bonds or putting it into some kind of annuity to defer the taxation till later, which isn't very helpful. It's still going to be, we're still going to pay the taxes, but it does get it out of paying. It gives us more room to do the conversions now. But Roth conversion is certainly something we've got to do, Peter, something that everybody should be considering.
Now, we talked about how there was never a dollar that went untaxed. One exception to that rule, John, with proactive planning, charitably inclined individuals do have the opportunity to perhaps make some dollars tax-free, both to themselves when they earn it and grow it, and to the charity organization of their choice.
Yeah, we're talking to our clients, and we have been ever since it came out, this rule, that they can take up to $100,000 of their deferred money, and they can gift it directly to a charity. And so we're asking them, instead of tithing to their church with their cash dollars, that let's figure out a plan and we'll give to the church directly from their account to the church account or to the university or wherever the charity is, so that we can get that money out without having to pay taxes. You can also start a family foundation and put money into their tax-free, and then a charitable foundation with some of the companies, and then pass that money out. But that $100,000 per year is certainly a way that we can give to charity. And if you're giving any money to a charity and you're still paying taxes or you're retired, you need to take a look at that, especially if you want to get the money out of the account. And it will count. You have to be 72 now, but it will already be doing a distribution, mandatory distribution, but it will count towards that mandatory distribution.
Now, John, some savers and investors may feel as though if they leave money behind to their own family generationally, it's their money, it's their problem, their tax bill to deal with after I am gone. But I don't think that any prudent saver or investor wants to leave the IRS as their largest beneficiary.
Well, I mean, I talk about this with my son all the time. If he's making $100,000 a year and I leave him $1 million IRA, then he's got another $100,000 a year he's got to take out. Now, that plus what his wife makes could put him in a much higher tax bracket than where he already is, plus eliminate the capital gains, the lower capital gains or no capital gains. So there is a lot of things that can happen to the overall tax planning for your former, your beneficiaries, later if we're not careful with how we leave this money. And it's certainly something we should talk to them about. We need to do multi-generational planning, just like we're doing planning for the retiree and the principal.
And that is something that, again, you speak with your clients about there at Gulf Coast Financial Services and plan carefully to help them accomplish?
Yes, when we meet with them, we talk and we do the financially focused income plan. That's one of the things we talk about is how we're going to pass this money on, the impact to the kids, and then make sure the kids are aware of what's going to happen. And this is what their potential liability could be. It's great to get that letter saying, hey, you've inherited money, but then you got to learn you got to pay taxes on it. It's not, sometimes it takes the joy out of it.
Talking tax today with John Kuykendall, founder, CEO of Gulf Coast Financial Services, here to help you structure that financially focused income plan for retirement. If you would like to sit down for a complimentary review, a retirement planning strategy session to look over your finances, your investments, your retirement plan, and understand the risks that you are taking, the fees that you're paying, and the taxes that you may be liable for, as well as how to have a written plan, a financially focused written retirement income plan for retirement. Pick up the phone, give a call, 386-755-9018. That's 386-755-9018, 386-755-9018. John, any final thoughts on our tax talk?
Well, the one thing I wanted to say, clear up, was it wasn't Will Rogers. It was Benjamin Franklin that said nothing but death and taxes are certain. Will Rogers said that death doesn't get worse when Congress is in session. And that's the difference between death and taxes.
Sometimes it's feeling like we're taxed to death. And according to what we talked about today, we'll certainly be taxed at death for those tax-deferred retirement accounts, right?
And don't forget that in 2026, we're going to, the current tax law is sunset. And we revert back to the laws we had before, which were higher. The tax rates were higher. There's no telling what's going to happen. The government certainly is going to change the taxes that we have after 2026. So now's the time to get to planning.
Be proactive, ladies and gentlemen, and take better control to minimize that tax liability. Keep more of your hard-earned money. The team from Gulf Coast Financial Services can help with that financially focused written retirement income plan. Always a proactive perspective on tax planning. 386-755-9018. That's 386-755-9018. By the way, sister company, Gulf Coast Tax Advantage, all under one roof. So if you need tax prep or preparation or planning proactively, you can do it right there at Gulf Coast Financial Services, along with Gulf Coast Tax Advantage. One of the advantages, one of the several that the clients of Gulf Coast Financial Services enjoy. John, thank you for being here, as always, providing your guidance and perspective on what we need to do to stay financially focused.
Thank you, Peter. It was great being here.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services Inc., a registered investment advisor in Florida. Gulf Coast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors, including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.